What's up, everybody? It is Tuesday, March 11th. Check it out. Nice tomato that I picked today. No more rats, no more raton, at least not right now. I keep the traps going though. See what happens. So today the market was down. Trump came out. He kind of doubled down on his tariffs against China and stuff like that. The market tried to rally and it failed. And I'm telling you guys, until we get an increase in the debt ceiling, we're going to have this problem. And I explained it yesterday. I think yesterday my analogy was a brilliant analogy, if I may say so myself. You know, I'll just quickly go over it. We have a system, okay? The government creates a system. We call it the financial system. And it applies rules to that system. The system has rules. And all the players who have to apply to be in the system, they have to abide by the rules. And the rules state that whatever assets are in the system have to be capitalized to a certain percentage. We'll call it 3%. That means if there's $1,000 in the system, the players in total, the system has to be capitalized for $30. You get it? But if the assets increase very rapidly, then it falls below that 3%. Okay, because you're gonna have more assets, so the denominator gets larger. The top, let's say the capital is the same, then that ratio gets smaller. It drops below 2%. And a lot of the players, they don't want to have just 3%. They maybe want 5% or 6% or 10% because it's like I was saying yesterday. If you have a checking account balance that's normally, let's say, $1,000 and you're comfortable with that, you like to have it at least 1,000, if not more. If it starts falling below 1,000, even though you're fine, you're not overdrawn, you know, you feel a little bit uncomfortable, all right? Because you don't know what might pop up. You want to keep it at that 1,000. Same with these players. They don't just keep it at 3%, their capital. They keep it higher because, you know, every year there's a stress test by the Fed, and they don't want to get too close, all right? So they keep a buffer. So anyway, what happens is, there's also a mechanism in that system. If it gets overloaded with too many assets too quickly, sale of treasury securities, it acts like a bilge pump. I use the analogy of a bilge pump in a boat. Let's say you're cruising along, your boat's fine, that's the financial system. All of a sudden a rogue wave comes along and a whole bunch of water inundates the boat. What happens? The bilge pump kicks in and it drains the water out of the hull. It's there as a safety protection mechanism. That's exactly what the sale of government securities is. It's not borrowing. It's a drain. It's a reserve drain, okay? So what happened in the last 2 months, and really almost recently, was that all of a sudden, not all of a sudden, but as a consequence of regular government spending, and remember, the government's spending $7 trillion annually. We just had a month, February, you know, where it trended almost to $1 trillion. That's like a huge dump of assets into the system, but the bilge pump was shut off. It wasn't that it wasn't working. Congress shut it off. That's the debt ceiling. Oh, we have this arbitrary thing called the debt ceiling, which is the bilge pump, and they just decide to shut it off, you know, every couple of years. Why? For no real reason. They just think, well, if we keep the bilge pump going, then the boat is going to accelerate out of control and it's going to crash. That's basically, you know, the kind of thinking that they're using. There's no connection between the bilge pump and the boat accelerating out of control. But every couple of years, they say, we got to stop. We got to shut off the bilge pump, because if we don't shut off the bilge pump, the boat's going to accelerate out of control and it's going to crash. Crazy. It's crazy. So the boat just got flooded with water, the system. which is this huge 500 billion dump in reserves. And the bilge pump is shut off. And meanwhile, Congress is here trying to figure out, should we put it back on? Should we leave it off? It's fucking ridiculous. It's bullshit. So this is what's going on. The system now just was exposed to a lot of disruption because the water came into the boat and the bilge pump is off and you can't pump it out. That's basically what's going on, okay? That's all I'm going to say. So we need to have the debt ceiling increased, and then this whole thing is going to stop. It'll stop, and then we have to see what they're going to pass in their spending and tax bill. You know, the point is, number one, you need the debt ceiling to be increased because this is very, very destabilizing, as you could see. You got the bilge pump is shut off for no reason. They just say if you don't shut off the bilge pump every couple of years, the boat's going to accelerate out of control and it's going to crash. It's just fucking ridiculous. There's no connection between the bilge pump and the boat's throttle. So that's number one. Number two, we got to see what comes out of this spending and tax bill. If it's a net reduction in spending, that's what they're talking about, okay? Then the economy is going to have problems, okay? And if the economy has problems, like I've been telling you guys, stocks follow the economy. I think, frankly, right now, what's going on in the market has nothing to do with the economy. I'm going to state that flat out. And Trump says ignore the stock market. And I think he's right up until this point. There is absolutely, and I could tell you this unequivocally, there is zero slowdown in fiscal flows, transfers, net transfers, leading flows. As a matter of fact, they're going up. Okay, so all of this is an emotional reaction. This is investors projecting ahead like, oh my God, this is going to be horrible. This is going to be terrible. And they got scared too, because you had that Atlanta Fed first quarter GDP forecast of minus 2.4%. It's minus 2.4% now. It was originally 2.8% negative. And that's a one-time thing. That was everybody jumping in front of the tariffs to order stuff before, the tariffs went on. That's all it is. That's not a big deal. And if anything, it shows you that the economy has strong demand. All right? So that's what's going on right now. I don't have a problem. As a matter of fact, I was buying stock today. I put out an email. I told my people what I was buying today. I gave them the names of the stocks I was buying today, okay? Now, I want to talk about something else, which it amuses me. It makes me happy, but at the same time, it pisses me off, if you could understand that. And what I want to talk about is the monetarists. We see this almost every single day, how their theories have holes in them so big you could drive a freaking Mack truck right through them, okay? I was just looking back. Like right now, we see the dollar is going down, right? Two things I want to say about that. Number one, in 2018 and 2019, the last time Trump was in office and he imposed tariffs, everybody was buying the dollar. The dollar was going up back then when he imposed tariffs. That was somehow bullish. And I said, no, it was. At the time, I was saying that's not bullish. But the dollar was going up. Okay? Now, we got the tariffs going on, and the dollar is going down. So they're arguing now that it's a bearish thing. Before they were arguing it was a bullish thing. Same conditions, different interpretation. For what reason? I have no idea. That's number one. Number two, and there's so many examples of this. I'm not even going to, I shouldn't enumerate them. I'll just give you some example. Now we also have the United States has the highest interest rate. The Fed policy rate is the highest of all the industrialized countries. It's higher than everything in Europe, including these basket case economies like Italy and Spain and Portugal. Okay? It's way higher than Japan. All right? It's higher than Canada. And the monetarists have always told us that high interest rates are good for the currency. Never mind the fact that when they try to do that in Turkey, or when they try to do that in Argentina, or when they try to do that wherever, it collapses the freaking currency. So the dollar is crashing now, even though U.S. has significantly higher interest rates than all these other countries, some of them absolute economic basket cases, as I just mentioned, okay? And yet they're allowed, these monetarists are allowed to continue with this garbage bullshit that they spew out, and nobody ever checks them on it, except for me, all right? But I'm nobody. I'm just, you see, I'm just sitting here by myself. I got fucking like, yeah, I'm lucky I have you guys listening to me, okay? So like, how does this go on, man? The other thing, remember when they were telling us, oh, the Fed's gonna, oh, this one, they're printing money, they're juicing, they're pumping. I did this yesterday. We just had a 500 billion injection, a pumping of reserves, of money, of printing, and the freaking market is crashing. Nobody says anything. Whatever happened to they're printing, they're pumping, they're juicing, they're printing, they're pumping, they're juicing it up. It's going down. Okay? And remember when they were telling us that, oh, the Fed now is going to reduce its balance sheet. They started telling us that already in late 2021. And I was telling you guys, I said we're going to come back and revisit this. Go back and watch my things from 2021. I said we're going to come back and revisit what I'm telling you. The reduction in the balance sheet was going to be bullish for stocks, and they were going to go to new all-time highs. And that's exactly what has happened. Nobody questions them on this. How many times have we heard them say the inverted yield curve is an absolute predictor, infallible predictor of recession? I said that doesn't apply anymore. We're not on a gold standard. We're not on a fixed exchange rate situation. It does not apply anymore. And we went 5 years with an inverted yield curve and there wasn't a recession. And then when the yield curve flipped back to positive slope, which they ostensibly they tell us that's a good thing, then they were saying, well, that's really the recession indicator. I mean, these guys are fucked up beyond belief. And you have a whole entire universe, including a lot of people on here who post up stupid ass comments, a whole entire universe of leading academics and Wall Street people who follow this crap and keep spewing it out and pushing it out there, this garbage. You have to go against them. You have to. Even if it doesn't work out right away, even if you know nothing, you cannot go along with theories and ideas that are blatantly wrong and proven wrong time and time again. That's why I love when I got comments on here. Oh, MMT, what bullshit. People still believe in it? Please keep saying that, because you want to know something? That shows me that there's lots and lots of people out there whose money I can take. And it gives me so much joy and so much pleasure, because I love taking money from stupid people. It's like my pastime. It's my hobby. Okay? So keep saying that and keep posting it up. I love it. Anyway, that's it for today, folks. I hope you're doing well. And Yeah, that's it. Don't forget, please like and subscribe if you've done that. Thank you very much. And go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.